Imagine the potential of turning your money into a monthly income engine, yielding up to $60,000 annually. Welcome to the universe of investing, a realm where financial dreams can materialize into reality. You see, investing is not just about growing your wealth, it's about leveraging the power of your money, making it work for you, and transforming it into a consistent income stream. It's about achieving your financial goals, be it a comfortable retirement, a dream home, or simply the freedom to live life on your own terms. Now let's talk about two popular investment vehicles that have been making waves in the investment world. Meet SCHD and JEPI, two exchange-traded funds or ETFs that have been helping investors like you and me to navigate the financial seas. SCHD, short for Schwab US Dividend Equity ETF, is a fund that focuses on companies with a strong history of paying dividends. It's like investing in a group of reliable friends who regularly chip in to support your financial goals. On the other hand, we have JEPI, the JP Morgan Equity Premium Income ETF. This fund employs a unique strategy involving options to stabilize returns. It's like having a financial wizard in your corner, using sophisticated strategies to generate income even in volatile markets. Each fund carries its own set of risks and rewards, and understanding these can be a game changer for your investment journey. SCHD and JEPI offer different approaches to achieving your financial goals, and each has its own charm. SCHD banks on the stability of dividend-paying companies, while JEPI uses its financial acumen to bring stability amidst market volatility. Understanding the mechanics, risk levels, and potential returns of these funds is crucial in making informed investment decisions. It's like choosing between two distinct paths to reach the same destination. But remember, the choice is always yours to make. So, are you ready to dive deeper? Let's delve deeper into these two investment options and see how they can work for you. As we embark on this journey, remember, the power of investing is not just about growing your wealth, but about transforming it into a tool that can unlock a world of financial possibilities. SCHD, or the Schwab US Dividend Equity ETF, is like having a golden goose in your portfolio. It's an investment vehicle that offers you a piece of some of the highest dividend-yielding companies in the United States, allowing you to tap into their profits. So, what's the secret sauce behind SCHD? Well, it starts with the selection process. SCHD doesn't just pick any company, it targets firms that have a record of consistently paying out high dividends. These are typically large, mature companies that have stood the test of time, businesses like Procter & Gamble, Coca-Cola, and Johnson & Johnson. These are the kind of companies that can keep the dividends flowing even in tough economic times. Now, SCHD doesn't just stop at picking great companies. It also ensures that your investment is spread across different sectors. This diversification helps to lower the risk and increase the stability of your investment. So whether the tech sector is booming or the healthcare industry is having a rough quarter, your investment in SCHD is designed to weather the storm. But how does SCHD actually put money in your pocket? Well, that's where the dividends come in. SCHD pays out dividends on a quarterly basis. That's right, every 3 months you get a slice of the profits from these high-performing companies. It's like getting a paycheck, but you don't have to do any of the work. Of course, like any investment, SCHD isn't without its risks. The value of your investment can go up and down with the market. And while these companies have a solid track record, there's no guarantee that they'll always be able to maintain their high dividend payments. But overall, SCHD offers a unique combination of potential profit and stability. It's a tool that allows you to invest in some of the most successful companies in the US and share in their profits through regular dividend payments. SCHD provides a steady income stream, but let's see how JEPI compares. JEPI, or the JP Morgan Equity Premium Income ETF, is like a well-oiled machine, regularly pumping out returns. But how does it work? Well, JEPI employs an investment strategy known as a covered call strategy. Let's break that down. A covered call strategy is a financial strategy where an investor holds a long position in an asset and writes or sells call options on that same asset. Think of it this way, it's like renting out a property you own. You still hold the deed, but you're generating income from it on a regular basis. Now, JEPI uses this strategy on a portfolio of equity securities. This strategy allows JEPI to generate extra income from the option premiums, which it then distributes to investors in the form of monthly dividends. This is a key difference from SCHD, which distributes dividends on a quarterly basis. But there's another layer to JEPI's strategy that sets it apart. It doesn't just write covered calls on any assets in its portfolio. It focuses on writing calls on securities that are less likely to appreciate significantly in the short term. This way, the ETF can still benefit from the long-term capital appreciation of its holdings, while also generating income from the option premiums. JEPI's strategy is particularly effective in volatile markets. When markets are choppy, option premiums tend to increase, which means JEPI can generate more income from its covered call strategy. This can provide a buffer against market downturns and help stabilize returns. So, what are we left with? JEPI is an ETF that uses a covered call strategy to generate monthly income. It's designed to provide a steady stream of income even in volatile markets, and it has the potential to appreciate in value over the long term. JEPI offers a steady and often larger income stream, but how do these two options really compare? It's like comparing apples to oranges, each has its own flavor and benefits. As we delve into the comparison between SCHD and JEPI, it's crucial to remember that every investment comes with its unique set of attributes. Let's start by looking at SCHD, the Schwab US Dividend Equity ETF. This fund primarily focuses on companies with a robust dividend history, which offers a certain level of stability for investors. The risk level here is moderate, as it mainly comprises large-cap companies with a proven track record of distributing dividends consistently. The potential returns of SCHD are largely tied to the performance of these companies and the overall market. The expense ratio for SCHD is quite low, standing at around 0.06%. This is one of the significant advantages of this fund. In terms of portfolio composition, SCHD has a diversified set of holdings across various sectors, providing a good balance for investors. Let's imagine we invested $100,000 in SCHD. Over the long term, considering historical data and market trends, we could expect a substantial return on our investment. For instance, using a conservative estimate, we might see an annual dividend yield of around 3%, which would equate to around $30,000 over 10 years. Now let's turn our attention to JEPI, the JP Morgan Equity Premium Income ETF. This fund employs a covered call strategy which can generate income even in volatile markets. This strategy, combined with its monthly payout schedule, makes JEPI a compelling choice for those seeking steady income. The risk level of JEPI is relatively low due to its strategy of selling options, which can mitigate the impact of market downturns. The expense ratio of JEPI is slightly higher than SCHD, coming in at around 0.59%. In terms of portfolio composition, JEPI also offers a diversified spread of holdings across various sectors. However, it additionally includes options, which can provide extra income in volatile markets. If we invested the same $100,000 in JEPI, we could potentially see a higher return over the long term. Given its strategy, it's not unreasonable to expect an annual dividend yield of around 6%. This would equate to over $60,000 over a 10-year period, double what we might see with SCHD. In conclusion, SCHD and JEPI are both solid investment options with their own distinct advantages. SCHD provides a stable income from proven dividend-paying companies, while JEPI offers the potential for higher returns through its unique strategy, even in volatile markets. Both SCHD and JEPI have their merits, but which one should you choose? That's the million-dollar question, isn't it? But remember, the right choice depends on your individual financial goals and risk tolerance. So consider these factors carefully before making your decision. Now, the million-dollar question, or should I say the $60,000 question, SCHD or JEPI? Let's take a moment to ponder. SCHD, the ETF that offers dividends from stable companies, has a unique appeal. It's all about consistency. By focusing on companies with a strong dividend history, SCHD provides a steady income stream that can be a rock-solid foundation for any portfolio. The benefits are clear: cost efficiency, tax advantages, and industry diversification. But it's important to remember that these returns are quarterly, not monthly. On the other hand, we have JEPI. This ETF offers monthly payouts, which can be a game changer for investors seeking a more consistent income. JEPI's strategy is a bit different. It employs a covered call strategy to stabilize returns even in volatile markets. This means that while the market may be on a roller coaster ride, JEPI aims to keep your returns steady and reliable. Plus, let's not forget that JEPI's potential monthly dividends significantly outpace those of SCHD, with the potential to yield over double the returns on a $100,000 investment. But what about risks and expenses? Both ETFs have their fair share. SCHD's focus on dividend-rich companies can be a double-edged sword, tying its performance closely to these firms. JEPI, meanwhile, has a slightly higher expense ratio, reflecting the cost of its more complex covered call strategy. So which one to choose? Well, it depends on what you're looking for. If stability and consistency are your top priorities, SCHD could be your best bet. But if you're after a higher income and can tolerate a bit more risk, JEPI seems to be the more promising choice. In the end, the choice between SCHD and JEPI comes down to your personal investment goals, risk tolerance, and income needs. Both offer unique benefits and come with their own set of considerations. Remember, investing is not about getting rich quick. It's about growing your wealth over time. To quote Warren Buffett, "Do not save what is left after spending, instead spend what is left after saving." Wise words indeed, especially when we're discussing the power of investing. When we put our money to work, we're setting up a future where we're not just surviving but thriving. Now, we've dissected SCHD and JEPI, two powerhouse investment options, and as we've seen, both have their unique strengths. SCHD with its focus on companies with a strong dividend history, and JEPI with its steady income and lower volatility, thanks to its covered call strategy. But as we delve into the world of investing, it's vital to remember that there's no one-size-fits-all approach. Each of us has unique financial goals, risk tolerance levels, and investment strategies. Some of us might be saving for a new home, others for our children's education, and some of us are just looking to grow our wealth over time. The trick is to find the investment option that aligns with your goals and risk appetite. If you're looking for stability and are comfortable with slower growth, SCHD with its focus on stable companies could be your choice. But if you're seeking a more aggressive approach with potential for higher returns, even in volatile markets, JEPI could be the way to go. It's also crucial to consider the cost efficiency, tax advantages, and diversification that ETFs like SCHD and JEPI offer. By spreading your investments across various industries and assets, you're not just banking on one horse but on the entire race. It's a safer, smarter way to invest, one that can lead to impressive dividend payments and capital growth over time. And remember, investing isn't about instant gratification. It's about patience, consistency, and the power of compounding. It's about making informed decisions today that will pay dividends tomorrow. Investing is a journey, not a destination. So start your journey today with the right investment option. Before we wrap up, we'd like to take a moment to thank all our viewers for their support and engagement. We encourage you to keep the conversation going in the comment section below. Got questions about SCHD or JEPI? Or perhaps you have your own investing secrets you'd like to share? Feel free to drop a line below. We love hearing from you, and we're always keen to foster a community of informed investors. And if you found this video insightful, don't forget to give us a thumbs up and subscribe to our channel. We regularly bring you content that helps you navigate the world of investing and make informed decisions. So, hit that subscribe button and never miss an update from us. Also, remember to click the bell icon to get notifications for our latest videos. Once again, thank you for tuning in. We appreciate each and every one of you. Until next time, happy investing.